Good morning, everyone, and welcome to the European crossover webinar. And we're seeing the dollar trying to at least attempt to hold on to the good gains that it did have. We saw the euro pair back here, and really, as we saw the dollar come back with, I think I mentioned the Asian analysis with a bit of a vengeance. Even here with the dollar CAD, even trying to push up here, pretty key area here. Really quite the move here in the dollar CAD as we came back and jumped up even past this trend line up here at this 34.15. We'll cover this area. It's actually on the daily. I'm looking here at 34.12 here for the dollar CAD here. We'll just take a quick look at that. But even here, this is quite the jump here. And the dollar CAD, as the dollar came back, the dollar was struggling throughout pretty much the entire week. Finally, on Friday, it turned on the afterburners and really pushed. I guess people didn't want to stand the way, and they saw the retail sales. Although, once again, we did get a good piece of data in that, but that's a good piece of data among a plethora of not very good data whatsoever. So we'll get into that. To me, if you ask me, I think that the dollar is very overstretched here in the sense, and here's the reason why. If technically, wow, nice rebound, but I do think that within these next two meetings, and if you saw Blake's the week ahead video, I'm in complete accord with that. My thought process is being the same thing in the sense that the thought was, actually, I was even surprised myself. It was, I think it was Tuesday. The Fed's pricing tool was pricing in a 17% chance of a cut by the Fed at this meeting. By the time Thursday rolled around, it was already pricing in a 23% cut. I think for whatever reason, I think the market, swung back, but it swung back so hard. Not questioning that it swung back, but it swung back with such vengeance here with the dollar. But that being said, I never was of the ilk that they were necessarily going to cut at this meeting, but I thought it would be the next meeting. But Blake laid it out right also, is that the case is going to be that potentially they're laying out the case for bringing on the next cut. And I think I don't think it's a question of whether the Fed will be dovish. They would be dovish because I think the whole situation with the China thing isn't going anywhere, going anywhere anytime soon. And I think there was a great article that I saw here. Probably should bring it up. Looking here that this possibly could be the same thing that Greenspan did back in 1995, where he presaged the situation really was because of the tightening rates, where they stepped in ahead with a cut and allowed the extension of the equity market run. Well, I think the China thing is really going to go and have its own issues further down the road. And I'm looking down here but I thought it referenced that, and also, I'm going to go and touch back on that. I'll get to that and give you an idea. I think Stelio's had some talk here in the on the chat room, and this is really along the same lines that I was thinking myself. And let me go and get you that. We'll know kind of where I stand on this whole situation. We'll go and switch into that. And one moment, let me see if I can. I had not intended on bringing that up, but I thought that it helps here. So let's go and get to this. And you'll see where I'm going at. Right or wrong, at least we'll kind of see what we're referencing here. And this came from, you can see here, is it 1995 all over again? Bloomberg's John Authors cited a piece by Fulcrum's Glenn Davis discussing the similarities between the current state of central bank thinking and the situation in 1995. You can find the piece here. In 1995, the Fed eased policy preemptively, encouraged by the lack of inflation, which the Fed heads have been, on their mention, hey, there's no inflation, and staved off a recession that was a risk after the sharp tightening cycle of 1994. Fed Chairman Alan Greenspan says the 1995 soft landing cited the 1995 soft landing as one of the Fed's proudest accomplishments in his tenure. One notable side effect was to add fuel to an equity market that had already started when the 1994 tightening cycle ended. The S&P gained almost 300% in the next 5 years, and perhaps that's why Paul Tudor Jones told Bloomberg this week that when a Fed easing cycle starts, you're supposed to sell the dollar and buy equities. Mr. Jones has a very good trading track record, but perhaps the key question is whether the Fed can stave off a recession. Clueless was one of the most financially successful films of 1995, and would be unfair to say that either the Fed or the market is clueless. No one is sure whether we are facing the definitive downswing in the current economic cycle or another mini pause. Fed is tempted to follow the market's pricing of rate cuts by easing and buy itself insurance against recession again. If he succeeds, Mr. Jones will win. But if President Trump's trade policies and the downturn of the U.S. earnings cycles mean that a bigger slowdown is inevitable, buying bonds in the end may be the only winning trades. We're going to get back. Hang on, let me click off this. Hold on. I hope there was audio on that piece while we were talking, but that's my thinking here because I saw it said the unmute button, but I did click on the unmute button, but we'll find out. But that being said, that's my take here. Is I think we've got a pretty good stretch here in the cash dollar index, but my thinking is that within the next couple of meetings, the Fed will cut, and I think that's going to be to basically. I think we have hit, as I said, a natural stretch here where in the U.S. economic cycle. We've really overstretched here, but the data has been weak for some time, although we got that good retail sales. But I think the market may have come back with a little bit too much of a vengeance. And even if the Fed doesn't cut this meeting, and I wasn't thinking they would, that I believe they are going to go in and lay the steps or lay the outlook for a cut potentially at the next meeting, and why I question if the dollar is going to be able to hold this. I think the dollar, now if the Fed were to be not dovish, a bit, hard to think they'd be hawkish, but if they were quite a bit less dovish, yes, you could see the dollar extend, but I don't think that's going to be the case. And once again, as Blake had pointed out in the week ahead video, it's really going to be all about the FOMC this week. I just think that the stretch here in the dollar was way overdone. So that being said, let's go on and move into the stories, and we'll get into the analysis. The jury's still out whether Boris Johnson benefited from choosing not to take part in a largely inconclusive TV debate on Sunday night with other Conservative Party leadership candidates. His team may well judge that, given his comfortable lead after the first round. He was right to avoid a testy confrontation that would have triggered mistakes. He's also absent from a closed-door hustling today with political journalists before Tuesday's second round. Separately, Labour leader Tom Watson is set to increase tensions within his party over Brexit by calling today for its official party to be unequivocally that of remaining in the European Union. I don't want to spend any more time on that. In the week likely dominated by the Federal Reserve's policy decision on Wednesday, stocks markets were hesitant first thing. Much of the focus remained on the U.S. dollar surge on Friday. After the above forecast, U.S. industrial production, core retail sales readings for May, as well as an upbeat consumer confidence soundings, the surprisingly strong economic numbers have pushed the futures back, with the expectations of the Fed rate cut as soon as this week to less than one chance in 5, although rates markets still remain priced in for a move in July. I think that that's going to be the case, and I do believe that that's going to be the case, but as I said, I think the market may be pricing in, I don't necessarily want to say hawkishness, but too much less dovishness because, with the exception of the retail sales, all the data has been coming in weaker and weaker and weaker. And I mean, all you have to do is point to last week's NFP, and you already start to see that slide. Now, that doesn't mean okay, it's a cut this time or totally discount the retail sales. My point being is, I think this FOMC meeting is going to be about expectations. I don't expect them to cut, but once again, all you have to do is point to the NFP and see this slide back, and I think it opens the door for them to lay the groundwork for the cut next meeting, and I think that pulls the buck back down. As a result, the dollar index staged its biggest one-day rise in almost 3 months on Friday and held those gains first thing today. With traders eyeing the European Central Bank's annual showpiece conference in Sintra, Portugal on Monday, Eurodollar continued to test the 112 on the downside. That helped European futures move about 0.3 higher before the open. European sovereign debt yields ticked higher in sympathy with backup in U.S. short-dated yields. 10-year U.S. Treasury yields rose 2.1%. Above that, and Asian markets were mixed. With that, we're just going to move into FX. Australian and New Zealand dollars nurse losses, housing data, some help. The Australian and New Zealand dollars huddled near multi-month lows on Monday after their U.S. counterpart got a lift from upbeat domestic data, a stark contrast to the disappointing numbers out of major trading partner China. The Aussie was hanging grimly to 68.79, having skidded as far as 68.62 on Friday. Its low since the flash crash of early January, it shed 1.6% last week as mixed economic news saw bond yields hit an all-time trough. The Aussie was pressed by safe haven yen, break below major support around 75. This cross tends to be regarded as a weapon of choice on risk-off events and technically is now looks vulnerable to the downside, Rodrigo Cottrell, FX strategist at NAB. The Kiwi dollar stood at 65.05 after shedding 2.6% last week to a whisker above its May trough of 64.82. Both have fallen on Friday after Chinese data showed industrial output there it slowed to a 17-year low in May as trade war with the United States took a toll. The Aussie is often used as a liquid proxy for China, given that the Asian giant takes more than a third of Australia's exports. The U.S. dollar also got a boost after retail sales proved much firmer than expected and nudged Treasury yields higher. The Federal Reserve will announce its latest decision on Wednesday, and markets have been waging that it would take a more dovish tack given slowing inflation and global trade risk. And this is exactly what I think is going to go and happen. I never thought that the Fed would cut, although when I was reading over there, I thought, wow, there was a possibility. There are a couple issues if they were to cut. If they were to cut, people are going to look at the retail sales and say, wow, the retail sales are very good. What does the Fed know that we don't know? But that being said, I think the Fed's going to have to cut by no later than July. And the reason is not only are we getting slowing data here in the U.S., and it's continued to be that way, but I think the China thing is really going to get a grip. And I think it's going to go and impact in a more pronounced way, not that it hasn't. I think it's going to go and impact global markets coming up rather quickly. And that may be the Fed's concern, because if it does grab rather quickly in the next few weeks, then the Fed might be considered behind the ball by the time July comes around. And that, I think, is my biggest concern here, but we shall go on and see. Strong data keeps the dollar near two-week highs before the Fed meeting. The dollar held near a two-week high against its major rivals on Monday, ahead of a crucial U.S. Federal Reserve meeting that many expect will lay the groundwork for an interest rate cut to bolster the world's largest economy. While strong U.S. retail sales on Friday reduced the already low chance of easing this week and lifted the dollar, investors are betting Fed Chair Jerome Powell will leave the door open to future rate cuts in light of increasing economic strains. Now, like I said, if you look at the move that the dollar made, you'd be thinking, that's crazy. The dollar came back so strong. Look, I think the dollar came back because probably the market was short, and then I was mentioning that on Friday. I think this dollar is like a pendulum swing. It swings from one extreme to the other over the course of the last 2 months. Of course, the dollar was much stronger over that course, but sometimes you'd get these swings. And I think at this point is we have seen a lot of weak data up until this retail sales. And my concern is it's not so much that I think we're getting a natural pause in the economic cycle here in the U.S., but the situation globally continues to really get pulled down, and China at a 17-year low in output. Like I said, I think this is really going to, we're getting to a point, I think that, I don't want to go say to a tipping point, but I think we could start to see things accelerate worldwide as far as action needing to be taken. And by the time July rolls around, the Fed might be seen as waited too long. So I think it's a tricky one. And I think that the market, we may see the dollar in a different situation by the time even Wednesday rolls around. Obviously, if the Fed were to take this, I don't mean after me, but I think that the dollar could go on and end up paring back to factor in that risk. The dollar index versus the basket of major currencies was a little change at 97.47. As long as Powell does not rule out the near-term rate cuts, the dollar will be top-heavy after the Fed meeting, said Masafumi Yamamoto. And I think that is completely the case. I think that the Fed will be, because here's the deal with that. The Fed's not stupid. They're seeing what's happening. And it's not just here in the U.S., but what's going to happen there is eventually going to come here. And it's already starting to happen with the exception of the retail sales. So if they were not to rule out the rate, if they were to essentially not rule out the rate cut, but just barely give it any lip service, and then they come back in July and markets are really starting to slow down aggressively, and then they have to cut, they're going to say, how could you be, the Fed's going to be lambasted and roasted. How could you go in and say this in June and now here in July, here you go cutting. And and a lot of the Fed heads have been open to a cut. So I don't think that that's going to be the case. I think that they will be dovish. Expectations of an interest rate cut at the Fed's June 18-19 meeting fell to 28 from 28.3. Wow, they jumped up to 28 to 21.7 in the wake of strong retail data. I think it's saying that it's even below 20%. So that's where we stand here. The ECB also really recently raised the prospect of even more stimulus, while the Bank of Japan is widely expected to reinforce its commitment to maintain a massive stimulus program. Here's the beef here too, is that as the difference I was mentioning in the chat room, we usually don't spend this much time, but I think it's important as we come into the Fed thing, so we're all on the same page, right or wrong. Might be wrong, but at least I know we kind of looking at it. What I'm looking at is that the Federal Reserve has a lot more firepower because it had been raising than the ECB or obviously the Bank of Japan. If we start to if things start to really weaken, some of these assets, it's going to be a concern because they're going to feel that they don't have anywhere to go, because I think that even if the Fed were to cut, we would see a rally in equities, but I think it would be short-lived. It may only last like about a month, and then we're just going to look at the realities of the global issue, and we can see equities start to pare right back down again. The Fed cuts rates sooner or later, but so might its antipodian counterparts, such as the ECB, such as the views of the dollar is at an advantage. Let's go and move into the actual analysis here. So that's where we stand here. We're going to move into the, just want to go and give my, as the saying says, my 2 cents on that. And I think it's important. I think that, whenever we come to these FOMC meetings, that's always going to be the market will gravitate towards that as we come into the week. But I think it's really more so this time. I really do believe that. We'll see what happens. Let me just go on and note here. So it says the Euro bulls were dealt a harsh blow on Friday as the market closed below the major level of 1262. You can see it right there. And minor level 1221. Support comes in at 1204, confluencing with 1199, which is a 61%, followed by 1178. So we're right here. So we're going to put, but to allow, if they want to take an extra dip, we'll allow for 1178. On the upside, we'll go and take a look on the 2-hour chart. Resistance would be right there, 1247 for right now. And we definitely would have to put this into a bear's camp. Although I think things could change come come Wednesday. It's going to be interesting to see what would happen. Let's go and move into the cable. Cable is closed below key support level 2606, opening the door for a challenge of 2485, with 2526 providing minor support. Upside resistance is 2657, followed by 2730. For right now, we'll go right there with those lows, which 2558. We know that the door's open here for 2485 with 2526 for today. We'll go right those old lows, 2558. And for resistance, see the euro trying to come back a little bit here. Right there. It's going to be 2630. Now to the Aussie dollar. The Aussie dollar spent the week. Let's go and read this out of here. The Aussie dollar spent a week on a non-relenting downslide, closing a hair above support level 68.65. Next support level 68.31, dating back to January's flash crash. Upside resistance is 69, followed by 69.44. So we're going to go with 68.31. You can see that coming across here. I went all the way, I went with an hourly chart and had to go backwards. So that's how I came up with the 68.31. I tried to go with a 15-minute to see if I can see some further, but that support comes in here at 68.31. So let's go on and mark this. We'll go right there with 69.06. And onto the Kiwi. The Kiwi's attempt to sustain a break has failed miserably, opened the door to a challenge major weekly support at 63.89. Markets oversold with minor support at 64.72, resistance is 65.50. So we'll go with that 64.72. It's holding the 64.93 right now, but we'll go with this 64.72, which is that dip to new lows. So at least if someone was trying to buy, they would know what the risk level is. So it's going to be 64.72. That would be new low zone. And we mentioned that the upside was going to be 65.50, and right there it comes in. Actually comes in, if you go right there with this here, that puts us right there at 65.50. We'll go 65.50 on the resistance. Well, the dollar CAD came back very strong after breaking this trend line. But like with a lot of the dollar pairs, we came back and the dollar turned the afterburners on Friday. But once again, I think the Fed will cut by July. But I think the question is going to be how dovish will they be? And I think there's good cause to believe that they'll be very dovish as we come into the meeting on Wednesday. And I think that will actually end up bringing the dollar down as we look towards a rate cut. Then I think the market may have got tilted too far, but the same token, as I mentioned in the last couple of months on short-term situations, we've seen these pendulum swings in the dollar, which swings to, on a short-term basis, these highs or lows, and then turns around and gets it back up. I think in this case, I think what you'll see is, I believe, you'll see the market come back in, the dollar index, the dollar itself come back in to reflect the risk as we get closer to FOMC. But we shall see. That being said, let's move on. The dollar CAD came back with a vengeance, closing above the key level 33.82 and above the broken trend line. Exponential moving averages remain in sell mode. The market would require 2 consecutive closes above 34.12 for bulls to get giddy. 34.41 is a 61%. Support is 33.82 followed by 33.42. So yeah, the support's going to be right here, that key major level, 33.82. And we did mention 34.41 is a 61%. We'll go with that. We mentioned it. I thought I'd actually posted the fib on the daily. Maybe I didn't. Hang on. Surprising. I guess it didn't save it. But I did mention that 34.41. There we go. 34.41 is a 61%, so we'll put that as a resistance. Although I think right now this current 34.12 is pretty tough right in here. There's 37. We'll just go and mark that off. Nonetheless, 34.36. We get that pop up. 34.36, but 34.41 is 61%. I don't want to say this bullish, although we've come right back, but let's go in and range there. And let's take a look here at the peso. After falling back to earth, the pace was making marking time. Major resistance remains 1923.6 with support at 1903. There's no changes. Well, the only difference was, remember last week we had 1906 the whole time. Thinking we may dip back down. They didn't, but this 1923.6 has held like the Rock of Gibraltar. So that's going to remain the same, which has been. The only difference is now we'll move this down to 1903. And here's the dollar yen. Despite the dollar yen's run versus most other pairs, the dollar yen is restrained. Well, I said despite the dollar's run versus most other pairs, the dollar yen remains, or should say remains restrained. Upside resistance is 0.876, followed by the pivot of 927. Support is 780. So this 876 is still holding this market. I'm going to go with that, 876. Beyond that would be the pivot. We talked about 927 here. You can see that here. Support for right now would come in right there at 816 on a very short-term basis. Let's go move into the cash dollar index. The dollar index came back strong on Friday, closing above 97.31. Bulls need two further daily closes above 97.31 to force bears out. Exponential moving averages remain in a sell mode. Initial support is 97.15, followed by 96.91. Well, we've had a pretty good stretch here. There's no denying that. And here on this resistance level, there's resistance right here at this 97.57. You can see right there that coming along here. Actually, you take that right there. That's it, right at 97.60, which is, well, I think they may have just be just a little bit above that, but we'll go with 97.60 for resistance. Got to give the Dell its due. And 97.31 is going to be support. Once again, to reiterate, I think we'll see this dollar index. I mean, what a massive run back up here. Actually, I think it's at the biggest run, one-day run in, what, 2 months or something like that. But we've talked about this with the dollar index. I mentioned that a couple of times already, that we've seen these pendulum swings where the market goes up, swings up, then look at this, swings right back down, some extreme moves, swings right back up, then turns around, swings back down. So we've seen these pendulum moves. I think to me, I believe the market got carried away with itself. There's no doubt that the dollar index could come back. But remember how we languished Monday, Tuesday, Wednesday. Finally, Thursday, we start to move higher. And then on Friday, there's a major rip. But that being said, whether bullish or bearish, I think the market will need to pare back to factor in the risk as we come into FOMC. Whether you believe they're going to risk cut or not, in all likelihood, may not be cutting, but you're going to be factoring the dovishness to set up for the July meeting. And I think they will be cutting in July because all the data, one thing that's not disputed, the data has been weak all the way up until this retail sales. Okay, PMIs, most everything has been relatively weak, and so when you look at that, if if they were to not be dovish, okay, if they were to not be dovish to set up for a cut in July, then I think that not only data or reports coming in, within the states, but the impact of look that the output for China was the lowest in 17 years. The impact coming globally, I think, would then force them to cut in July. But here's the deal: then they're going to look like idiots stating, "Oh, everything's okay. They're not dovish," and then here's turn around and cut in July, and which would make things worse. I don't think that's going to be the case. I don't think they are going to be not dovish. I think they're gonna factor in where things are and really open the door, and with that could potentially bring the dollar down. Now, whether you think they will be or not, here's the deal: I think the market will still have to come back down to price in that potential risk, whether you believe there'd be that risk or not. So that's my take on that. Let's go move into the cross rates. Okay, here on the Kiwi yen, the New Zealand yen broke to new lows, spiraling to the next support level, which is 70.20, which is almost not too far away from it. Confluencing with 70.23, which is the 88%. The market likely to test the flash crash lows from January at 69.30. Resistance is 71.22. Well, we're certainly pushing lower here, down here towards the 70.20. We're going to go with that, which is the 70.20. Potentially the market moving down there. And I see the 71.02. And let's go move into the euro yen. The euro yen cascaded lower, finding support at key level 21.68, confluence with 21.71, which is the 61%. Pair needs to defend this level to avoid a challenge of 2090. Upside resistance comes in at 22.20. So we did go on to make this dip down here towards that 21.71. We actually even dipped below that right here. We'll go on and take a look at 2 hour. there. So go with 2163. And resistance right there, 2220. We're moving to the euro on. This had the potential actually to even break higher. The thing that saved it was the weakening of the euro, but you got to be careful with this one. Look here. Now we did go in and get, look, here's that key level. Remember the 63.41? The only thing that saved this from going to new highs and really taking the next step higher was the euro versus the dollar weakening. Matter of fact, that was one of the things that I'd referenced in the chat room. Was it, I think I mentioned also here, was when I had been short the euro versus the odd when they came out with the data the other day, and I was stuck in this thing. I was really kind of ticked me off that, we just weren't really seeing any two-way action. I think I mentioned even the resistance was 63.41, and the market only pulled back like 7 pips and just reasserted. So it was only the weakness of the euro versus the dollar that brought it down. And I ended up covering like mid 63 teens, and then like I think it's the 63.09, and I think we kept that as our support. But you can see here, we'll see what happens. But we had right here a very nice gravestone doji, followed by, right here, followed this bar here, but that's a very nice textbook gravestone doji at those highs. But we shall go on and see. Once again, I think that the euro has the potential to go on and come back. And I don't think so much that the euro is so great. I just think that the dollar got way overstretched here on this move. And you'll have to factor in, obviously, going back to the dollar, the risk as you come into FOMC. That may allow the euro to go and boost up, euro versus the dollar boost up. So be very careful there. That being said, euro versus the odd was unable to close above the weekly level resistance of 63.41, forming a gravestone doji. Initial support is the reactionary low level of 63.09. A daily close below 62.89 opens a challenge of 62 even, followed by near major support at 16.95. So right now we're there. We're going to go with that 78%, which is 62.67. That's the 78%. We're going to go with that as resistance. And 63.09, that reactionary level. This is actually the level where they held that evening, and then when they came back to this level and held it again. And I think they got a little bit below it, but they retook it again, and that's where we stand here. Let's go into the euro versus the Kiwi. The Euro Kiwi closed the week at its best opening at its best level, opening the door for a challenge of a weekly level of 73.09. Confluence was 73.05 to 61%. Support is 72.06 followed by 71.55. So that's going to be the resistance right there, 73.09. Resistance, looking on a 2-hour chart, I mean, not resistance, but support, go with 71.61. Let's go into the ASEAN. The death spiral continues for the ASEAN with a potential move to the weekly level of 74.02. The pair found some solace at 74.47. That's a 61%. Resistance comes in at 75.31, followed by 75.85. You can see right here that 61% right there. So we're going to go with that for support. 74.47. Right there you go. And resistance, well, we can take a look here on a 2-hour chart. It's going to be right there. To push it up just a little bit higher. If the gun stops. Go with 75.08 on a short-term basis. Resistance. And let's take a look here with the guppy. There's no rest for the weary as the guppy appears intent on testing 36.02. Minor support was found on the prior at 36.57. Resistance is 37.63, followed by 38.08. So certainly looks like they want to go in and push even lower. So we're going to go with this 36.02. We're not going to mess around. That's where they appears like that's where they want to go to. You can see this key 36.02. So we'll go with that. As sterling continues to remain weak. And resistance will be right there, 37.10. And sterling versus the odd. Great British pound versus the odd has formed a gravestone doji incapable of securing a close above 83.48. Initial support is 82.41, followed by 81.98. You can see here we've got this nice little gravestone doji here on Friday. Looks like the market is kind of run out of gas here, despite the continued weakness in odd. Trying to hold the support level. Resistance is right there. We talked about that 83.48. And support, if we do break low, is going to be 82.68. Right there, 82.68. Immediate support in that break low. With the weakness that you've been seeing here and exhibited by sterling, certainly that would be the potentially the case. Well, there's a bias chart. We've already given our thoughts on potential with the FOMC coming up in just a couple of days. And thanks for joining us here. We're going to get this posted. And thanks for joining us here on the European Crossover.